Oh, my music stopped. There it is. Hey, what's up, everybody? Welcome to the stream. Happy Friday to everybody. Yet another interesting week. On the docket today, we got a big pullback in crypto, which I definitely want to touch on. The news for today is, of course, SIVB, which is Silicon Valley Bank. And there's a couple of hot takes there that I want to talk about because Zero Hedge came out with an article today. Let's look it up. Of course, Zero Hedge is never hesitant to publish some FUD about how this is going to be, expect mass layoffs, the real world impact. Where's the other article I was reading a little bit earlier? Something about how it's not over And this is a sign for small banks to come. I think there was also a lot of kind of cross contagion with crypto where it was Circle had a lot of their deposits in uh, Silicon Valley Bank, and basically just a lot of venture capital startups, a lot of tech companies had their money in Silvergate Bank. Now, the high level why this happened, it's sort of related to bond prices going down. You know, the whole, I'll try to explain it for people to get confused. Bond valuations, yields, they go up and down inversely. But first, once again, thank you for the people filtering in. I stream this every Friday on Discord, YouTube, and TradingView. I enjoy those comments, those questions, and symbols to look at. Got a couple I already want me to look at, and appreciate it. I also have the Discord that I stream on, which is a trading community. I don't charge for it. I do not sell any copy trading services. People that do are just impersonating me, and they are dirty, dirty scammers and horrible human beings. Don't steal from people. So, but yeah, on the docket today, I want to talk about this SVB. Also, this pullback in crypto is something that I talked about last week. It's something I've been looking at for a few weeks, ever since the breakout in January. For those that have been looking to add to their crypto, this is an opportunity. But, big caveat there. Looking at it objectively, there's a certain set of conditions that need to be met for this to actually hold here and go up. And if it doesn't, I know that a lot of crypto people are not going to sell, but me as a trader, I'm looking at this as a tradable opportunity, but that means that I'm also willing to get out. So we'll take a look at that here in a second. First, a little recap of what all the markets are doing. I'm going to start with stocks, then move into crypto, because there's actually, let me pull up something real quick. NASDAQ to Bitcoin correlation. The old correlation that was prevalent throughout 2022 with, oh, that's an old article. I think there was one. There was a very common correlation between Bitcoin in 2022 and the stock market, or particularly NASDAQ in 2022. They were both being seen as risk on assets. What is the reason for that? The reason for that is because interest rates were going up. That meant that the cheap credit that was fueling the whole rise of 2020, 2021 in tech companies as well as crypto. Yes, a lot of Michael Saylor's money, not his money, borrowed money went into pumping up the price of Bitcoin. And as those interest rates went up, it just wasn't there anymore. And so all the way back to the jobs report in December, that's this big bearish bar right here on, it was actually Friday. Friday, December 3rd, was when the non-farm payrolls report came out for, I think, December. And we actually had the payrolls report come out for March today, but it was a lot more impactful in December of 2021. It was very telling that a jobs report in the United States, or basically what would people's unemployment rate have to do with the price of a cryptocurrency? Well, it's because it was interest rate sensitive. And throughout 2022, as rates were at first, back in this time, being rumored to go up, but then confirmed by the Fed going up, that is what killed the crypto valuations. It also killed a lot of the speculative stock valuations. And all that has been happening over the last year culminates in what happened with Silicon Valley Bank, because during this period of low interest rates, let's see if we can find a chart to really demonstrate that. Let's do the 2-year chart. I like the Fred a lot better. There we go. So through there we go. So if you'll remember, 2020 through 2021, this period through here, throughout the last part of 2020, the Fed dropped the interest rates to basically nothing, which meant that if banks were going to issue debt, if they were going to issue longer term debt, shorter term debt, it was going to be at record low interest rate levels. Now, that debt is still out there. A lot of companies use that to buy back their stock. And a lot of companies use that for investment. A lot of tech startups, they basically took that opportunity to capitalize themselves so that they'd be able to weather the future. I mean, if you can get a 1%, 2% loan for 30 years, yes. Why do you think some people bought houses at such exorbitant rates? Because they were pricing in rates going up, pricing in inflation. And if you can take out a loan for 30 years or even 15 or something like that, that is a win, especially with inflation at 8% as it is now. But that debt still exists. You write that debt, and still someone now you're now paying them that 1%, 2% interest rate, like a lot of companies were. That's a win for you if you took out that loan, but someone wrote you that loan. And now with inflation as high as it is, with other long-term rates at 4, 5, 6%, instead of getting the new rates, instead of getting 4, 5, 6%, you're now still getting 1% if you're a bank. And that's a problem. That means that you have to write down the valuation of that long-term debt, just like you have to write down the value of bonds. And so what Silicon Valley Bank did was they had a lot of this stuff. They had a lot of this long-term debt that was worth less and less as interest rates go up. And what they tried to do it smoothly. They realized that, Jerome Powell, I think it was earlier this week, one of the reasons the market went down was because he insinuated, he can't say it outright, he insinuated that there might have to be a little more interest rate increases. They're supposed to have 2 more this year. Maybe there'll be some more. But the key takeaway is that they're not going to stop raising rates. It is not the end of rate hikes. Therefore, whatever problems that banks are having with increased interest rates are going to continue, if not get worse. And so what the bank tried to do, let me see if I can pull up the thread I was reading about this. They tried to get some of these assets off their books. They tried to shift these into shorter term assets. They tried to buy U.S. Treasuries, try to offset this. But the problem is, once the world, the street, got news of it, it created a bank run, and people started pulling their money out of the bank. And you essentially had a bank run that caused a liquidity crisis, and that tilted them over the edge, since they are FDIC insured, which meant the government regulators had to step in and say, nope, you're done. And therefore, it's over for them. And apparently there was a person that took out a, let's see, where's that thing today I was looking at? Somebody 2 days ago bought, 200 puts, which at the time I think it was trading. See, what was SI? What was it trading at? 1 second. So on the day where before this happened, this was the daily of when it was trading at 267, the close of Wednesday. Someone took out how many is that? I had to do the math on that, but basically they put out a $7,500 position to buy March 200 puts. And with the bank destroyed, with it going to basically zero, at 2. It's basically 2. The contracts are going to be worth what? Let's see. So 7,500 divided by 0.25, 30,000. And then if it goes to 0, that means each of those is going to be worth 200. 1, 2. Can't be 6. Maybe it's 6 million. Maybe I got my decimal place wrong, but yeah, or 60 million, but pretty close to that. Yeah, that's going to be a problem for the market maker that sold that to him. But anyway, that's basically what has happened. And the question is this going to be contagious to the rest of the market? I like this quote by Bill Ackman today, where he's calling for a government bailout now. Now, Bill Ackman has never once in his career spoken publicly in a way that is just of pure virtue. He's basically talking his book. And so he really wants the government to come in and bail out his position because he's exposed in some way to this being a problem for him with banks. I'm not sure what he's got. I haven't looked exactly what he has that's going to be affected by this. Maybe just general bank stuff. But whenever he goes on publicly and starts talking about what people should do, it's only to talk about his book. And as far as the banking sector in this week, I don't know if this is a potential banking crisis. If anything, I'm actually starting to look at this as a opportunity because you got a lot of FUD, fear, uncertainty, and doubt in a particular sector. I maintain the position that as interest rates go up, banks will be able to make more money on that net between deposits and interest. Issuing loans at higher rates means more money, but I could be wrong about that. And the fact that I just don't understand, because as I was reading about this Silicon Valley Bank and learning more about the different types of bonds, everything from treasuries to corporate bonds to these, there's still mortgage-backed securities out there, as well as business loans that were issued at low rates. Those are definitely a problem for bank balance sheets because you had to devalue them, which lowers the capitalization of the bank because they still have these loans out there, but they're just not getting paid enough. And so they have to write down the value. Or in the case of Silicon Valley Bank, they did some accounting, not trickery because it's accounting. Everything's a little bit tricky. But they basically moved a lot of these low-yielding loans into something called held to maturity, which meant they didn't have to report them on their balance sheet. They kind of got to sit out there a little benign until a big thing happens. So that's going to be a big question coming up in the next week, probably looking at some of these banks. But that's going to be a question for the next week. All right, let's shift gears. Let's go back to talking about the stocks, and we'll talk about crypto to kind of finish things up. All righty. So I found this I'll clean up my day trading levels. So this is a quarterly chart of the S&P 500 index futures. For those that watch what I do either on my live streams or as I day trade, one thing that I really trust and rely on is what I call a TS recapture. And it's very simple. The red line is the 9-period median, which is coming from Ichimoku, called a Tinkinson. That's why I call it TS. But essentially, when you break through that line, that's your first sign of the trend showing weakness. And then a pullback to that can oftentimes give you a really good opportunity to short or long, whatever the case may be. Today, on the NASDAQ, there were 2 separate opportunities. A long based on that same pattern. It was a very nice, crisp level. I'll get more into that later if we get some time. But going back to the monthly, we're now below that, and we pull back to hold. And essentially, that is a 50% retracement of the entire 2022 move down. Now, why is this important? These levels just a 50% retracement of trends are key to containing a trend. If it's going to continue, you assume that it's going to hold at least half of the momentum that it has. And that's going to become very important when we get to Bitcoin here in a moment, because it's at its halfway point of the January trend as well. But the stock market, the whole, starting from January of 2022 down to October of 2022, that whole bearish year that we had, it pulled up in December of 2022. That was on the CPI report. And then January, this up move that we had here, that only brought us up to that same level and could not break through it through February. And now in March, we're pulling back. So the resistance is held on the stock market, and that's not bullish. That is not bullish at all. At this point, and this is what I've been watching, it had a chance to possibly hold the January trend. And here, that's the January uptrend, but last week, talked about it. It had its chance to hold that. Maybe that could have been a sign up, but no, it failed that. So now with today's big sell-off, what we have to assume is that the stock market is going to go through a little bit more of a pullback all the way to the beginning of the year's levels. Basically, the December and January lows. We're not far away from it, so the next level to look for is 38.55, let's call it, on the S&P 500. NASDAQ has been a little more interesting. NASDAQ has been more bullish. It was, in other words, it's held its supports a lot better. Earlier in the week, it found itself, again, here's another showing of how powerful these 50% can be. So there was a low from the beginning of March 2nd, set up a high on March the 6th, which was this week, this Monday, and then it pulled back to the 50% level in the middle of the week, did a little spike there, rose off of it, but failed to actually get up there. But still, this was a good tradable opportunity for traders to get in long for at least that short point. Now, all this volatility ensued, but it's just a good showing of how price can hold that level to be a tradable level. We don't know what the future is going to bring, but we know that that's going to be an opportunity. We got to look at VIX. VIX, the key level for VIX has been, for the last 2 years, the 19-20 range. That's where the market tends to top out when VIX gets to this level. Now, there's a little bit of back and forth at the beginning of the year throughout February, but now VIX, the volatility index of the stock market, has risen off this level. And when volatility rises, the stock market is typically going down. That is what we're seeing. And as long as it held this level, then we had to assume that this was going to be, the market was toppy. It's often a very good timing element. Back in 2022, when VIX got into this range, that was the March high before it went down again. Then we have the August high before it went down again, and then December, the CPI report, same thing. And this was very confusing to me. I was shaken back and forth. I didn't really want to call it, but now as we come out of this range, it makes a lot of sense. It makes a lot of sense. We can't really say that the market is bullish until we would get lower volatility. The market would be pricing in the market going bullish, the market of the VIX volatility index. So that's confirming market go down. Bitcoin is very, very important because I've been talking about this for a long time. Let's back up a little bit. So in January, after a whole year of bear, you had the FTX collapse in November, and down it went and created a bottom. The reason I put on this little technical analysis right here, Ichimoku, is because this is what I use to gauge the strength of a trend. I look for a confirmation when prices come outside of the downtrend and reverse to the upside. And so posted about it and made the point that on Thursday, January of this year, it finally entered a bullish trend. And that was sustained for quite a while. Got a lot of people very, very optimistic. But throughout this entire uptrend, you had to wait. You don't buy it here. You don't buy it here. And I know a lot of people want to, but a lot of that has to do with FOMO. A lot of people think, a lot of people want this to be over. This dip from the all-time highs. I don't know where people bought their Bitcoin, but a lot of people want this to be over, us to have this behind us, and us continue on to the six-figure Bitcoin that they were promised. And they're looking at this January trend as the start of that. But I don't think that's to be the case. And I think historically, you have to look back at the 2019 action, where following the 2018 bull run that took us up to 19K, you had that period of malaise. That brought us down to about the 6,000 range, followed by a big dump in November of 2018, all the way down to 3,200. And then price rose and entered a bullish trend. And it went for quite a while. It was a nice movement up. But while a lot of people may have taken that as an opportunity, and to be fair, Bitcoin being 19,000 now, it's better than buying it at 12,000 4 years ago. You'd be up. But you still had the panic, the COVID crash, to bring it all the way back down to a little peak almost to 3K, but more like 4K. So you had all this big bull run. It wasn't really fake. There was good money to be made there. But you still would have been able to buy it cheaper. And really the key that you would have been looking for in this is for it to hold the 50% of this bullish trend. If the trend is going to continue, it needs to hold the halfway point of the trend. And so when price broke below 8,500, now things get a little dicey. Whereas a lot of people that were buying at that point thought, let's just go back a little bit. A lot of people would have thought, okay, we're going up. We're going to see this kind of trajectory. We're going to go up here in 2019. We don't know the future. We're just thinking we're going to see 100,000 Bitcoin off this rise right here. But we did not. To be fair, it was too soon. You have to give it time for people's optimism, for people's YOLOing to work its way out, for people to call Bitcoin dead, which some people have, but not enough. And then you need a major broad market shock like COVID to get an even cheaper opportunity. Now, I'm not one of these people that are in the camp that say that we're going to go into a recession, that a recession is likely. I do not like to prophesize that, mainly because one of the key factors of recessions is it's unexpected. You don't see it coming. And the fact that everyone's predicting it, that everyone's seeing it, is almost sort of counterintuitive. So, but that being said, if we go into some kind of a market shock event, unfortunately, cryptocurrencies are still going to be considered a risk asset. And so the risk is still there, but you can also look at it on the flip side. It's an opportunity to get cheaper Bitcoin as opposed to buying it at even 20K. Now, a lot of people want to jump into it. They don't want to miss it. They don't want to have to buy Bitcoin more expensive. But I think the risk is still more to the downside. I still think that you can... What this should tell you here is that given everything else you can think of, at any point in Bitcoin's price, you can probably get it cheaper. It's a pretty hard thing to kind of, think about. But remember, a lot of people said that never in Bitcoin's history has it ever retraced below its last all-time high. The previous all-time high was 19K, and we got to 15. So throw out these notions out the window that things can't happen. I mean, a lot of people would have never thought that after a huge run in Bitcoin in 2019, a little short-term trend where it was up 250%, that you could have probably bought it cheaper or about as cheap upon a major market correction. And that's the other thing to think about. Let's say the Bitcoin does go up. Let's say it does go up to 40K, 60K. This is the same thing I told people when it was at 60K. I'll probably be able to buy it at about a 75 to 85% discount of whatever it is today, given Bitcoin's volatility. So, where are we now? Well, we had that trend, and it has now pulled back 50% of this trend. It looks really small in the grand scheme of things, but we got to take it piecemeal at a time. We need to see what happens at this level, this 20K level, let's call it. If we can get it to close, let me draw a bar. Let me draw a bar, not draw phallic symbols. If we can get some bullish bars, if we can get price back above this level pretty quickly, then what this ends up being is a buying opportunity for us to retest that high and for this trend to continue. So if one were so inclined to be buying Bitcoin, this will be a time. This is not a time, because the risk of something like this happening, a 50% pullback, was always present. Now that you have it, is actually a smart time. What happens, though, if we come back and we start to go down? What if we don't hold this level? What if in next week we start getting into the 19s and the 18s? Well, we turn our buying off. We turn our buying off because the next likely point that it's going to is to retest the low. Yeah, you can maybe pick up some stuff in here, but you're probably, highest probability, going to come down to retest the low. And at that point, you can say, okay, maybe we'll get a double bottom. But if you don't hold this 50% level right here, you enter into no man's land, the valley of risk. And then, of course, an even worse situation would be if it breaks the low. And in that case, 10K is the level. Why 10K? Because in Bitcoin's history, it's had 5 bear markets, and those bear markets range from the all-time high down from 75% at best, which incidentally happened to be 17K, to 85% at worst, which happens to be 10K. And we're still in the crypto winter. This could have been just a bear market rally. So while you can take a bet, a smart bet, a risk-adjusted bet, that this pullback is a buying opportunity, if it does not hold, I would stop until about 10K. Because at that point, you're going to retest that low, and that's a dangerous position for it to be, especially if it breaks that low. So that's the status right now of the price of Bitcoin. No fancy moving averages to show you. It's really just about levels and what makes sense from a risk standpoint. Ethereum, it is also pulled back to its 50% of the trend, but Ethereum is a little more precarious. Ethereum never really got back above that pre-FTX high. I'm short from there because it never really pushed up above that. And now it's also pulled back to the 1400 level. Need to look and see where it holds here too. But let's look at the Ethereum Bitcoin cross. Still holding steady. Still holding very steady. Not really seeing a big major change in their relative valuations. They're still very, very correlated. So no advantage to be had there. All right. And then, of course, for market updates, Tesla. Let me check some questions before I talk about Tesla. If you got questions, post in the chat. I'm going to read some. I know I've got some from Option Farmer here that I've been neglecting as I ranted. But yeah, if you have questions, just post them for me. Again, plug. I have a Discord trading community. I don't charge for it. I just post my ideas in real time. Otherwise, you got to wait till the end of the week, and then I sometimes forget things. So, all right, let's see. Options Farmer, I'm thinking by reading what you're wanting me to look at that you know a lot about markets, or excuse me, options and volatility than me. All right, so COV call strategies opposing their big popular ETFs. Wonder if we can get a Volmageddon type explosion in there someday. The thing about finance is you don't really get lightning to strike twice. What he's talking about with Volmageddon. Let me see if I can find that. There was a VIX short-term ETN, XIV. And what it did was it basically took rolling, I may be butchering this, but it took rolling contracts on, I believe, VIX futures. And, oh, that's funny. Volmageddon. And it put them into a product which people were able to buy, and it worked really, really, really well as long as volatility. Okay, so what basically happened was all these ads. Okay, this is a chart of XIV. This is from 2016 to 2018. What this product did was allowed people to buy into the trade, the bet, that volatility, which can be represented on VIX, was going to remain low and stay low forever. Let's go back in time. So this is what the VIX looked like in 2016 through 2018. Remember how we're at VIX 24 right now? Well, we were in single-digit VIX for a long time in 2017. And the reason for this was because the market was going up very, very slowly. You would sometimes have 3 to 5 point days in the S&P 500 futures. Today's movement, 20 points. Yes, the S&P 500 was a little bit smaller, but still very small movements, even relatively. And so what that did was that meant that volatility was very contracted. There wasn't much movement. There wasn't much volatility. And what happens in human nature is we get lulled into this sense of what is presently happening is going to continue into the future unabated. That's what we think. That's what we feel. And so what people were doing was betting that volatility was going to stay low forever and just keep getting lower. We were going to get 4 or 5 VIX. This trend going down, just like a big bullish trend, the trend down in volatility, as it was, just kind of a slow inch down, that this was going to continue. And so what people did was they bought into a product called XIV that allowed them to play this trade. And slowly it appreciated. So the trade that was expressed with some financial engineering in XIV was that trend that they had for 2 years was going to continue forever. But then you had what was called Volmageddon. And that was when the Fed released some, I think it was either minutes or, the Fed chairman said, okay, we're going to have to raise interest rates. And that shocked the market. Oh no, all that free money is going away. Same thing that happened in 2022. And the market dumped hard in February of 2018. And that blew up that ETN. It blew it up so much that basically went to functionally zero, and people that had bought into that, thinking it was once again, a great sliced bread, a great tulip, a great bubble, just got absolutely destroyed. It stopped trading, once it dropped below 99. So, what I think Option Farmer is asking is, are we going to see a volatility explosion like that in some of these other products? Well, I don't know enough about those products to say for sure, but I would caution against lightning striking twice because people have already learned their lesson. Like I said about recessions earlier, the thing that makes recessions so damning is that people don't see them coming and people aren't prepared against them. The fact that everyone's expecting a recession means that everyone is preparing for it. And so even if it does come, it's not going to be that bad. It's not going to be a definitive black swan. Black swans are things that people don't expect. Volmageddon, a black swan. What's going to be the black swan that's next? I don't know. I would hope that I am smart enough to see it coming, but the problem is you're not going to get very much validation from people. If you go around saying, hey, I see this thing happening, it's going to be a black swan, people aren't going to believe you because the evidence is not going to be apparent. Once the evidence is apparent, then it has happened or is happening, and the opportunity is probably gone. So it's sort of like worrying about getting hit by a car. You don't go around every day worried about it because that would mean you didn't have a very good quality of life. So that's the way I look at that. We need, in hindsight, major slowdown recession has been caused by the Fed when oil and inflation get spicy. It was around 2005 to 2008 for that cycle, but it finally made sense this time around. And we need more debt from the debt system. Money is a bottleneck. I agree. I guess I agree there. All right. Chintan. Hello, Norok. What is the Discord and link is down below. It should be either on the YouTube or on the TradingView. I said they let you put the Discord link in your TradingView signature. If you look at any of my ideas, it should be down there. All right. Tether, the black swan we need. Ooh, yeah. You had Luna. Luna crashed, and that created the down move of June of 2022. That was what this Bitcoin crash was right here. And then, of course, FTX was the other contagion, but it wasn't quite as bad because it really didn't affect the price. But, Tether, I've read all the FUD about Tether, the conspiracy theories. I don't know enough about it to say, and but yeah, if the Tether system collapsed, there's your real Bitcoin buying opportunity. Although I'm not sure how you would go about doing it. I guess you could buy a lot through Coinbase, but every article I've read about cryptocurrency this week has been the regulation uncertainty in the United States is hurting it. But I mean, right now there's a very big vulnerability in the Bitcoin, the price of Bitcoin. There's a big vulnerability in blockchain, and it's a vulnerability that basically allows nefarious agents to extort anywhere from 15 to 35% of people's wallets every year. It's a very big vulnerability that no one's really talking about or addressing. TLT. TLT is my boring ass trade of the year. At least that was what it seemed to be as we started going into this year. With the talk of interest, it's interesting that it's up today. I mean, the trade is still on. Hasn't really given me much thought for grief, but still long TLT. The actual TLT, not options. I didn't like the idea of taking options because even though slowness of TLT itself is probably priced in, unless you're going to take a leap option, in other words, out to next January or beyond, I don't think it's a very good way to express what could be the likely timing trajectory of TLT. But it's nice to see it up, 3.45% today as markets go down. And this kind of fits into it. Now that bond yields are within non-zero territory, new bonds being issued can actually have a positive effect as these get rolled into the TLT instrument. And going back to what I have really start here. So, all right, so Fed increases the number of rates, TLT goes down, which I think people were speculating on. Fed does what it says, 3 more increases in 2023. TLT slowly recovers, which kind of is. And then Fed lowers rates, TLT goes up. So it'd be interesting to see if we do get some kind of contagion here in the banking sector where the Fed has to reverse course. I don't think that's going to happen, but they say, oh, whoops, mea culpa, which was what happened in the Volmageddon, which happened in 2018. They basically put out that announcement that they were going to lower interest rates. The market panicked. Let's go back and look at that. So 2018's Volmageddon was right about here in February. We had, oh man, what a chart is this? I know a lot of people watching this probably weren't trading them, but I've been trading for the last decade. And man, this was an interesting close to 2017, and this was yet another January where I learned my lesson about Januaries. Januaries can either make your year or break it. They can either set you up for the year, or they can put you in the hole that you spend the rest of the year recovering. And that was what happened to me in 2018. 2018, I got burned on the follow-up to January, which was the February, the Volmageddon. Then I spent the rest of the year making that back up. Finally, I happened to be on the short side of October. Actually, Volmageddon was not when the Fed announced it. Later that year, Christmas of 2018 was when it did. Yeah, October, we sort of recovered. I saw some individual opportunities in so basically puts in some companies. I forget now. I had to go back and look at my records, which ones. And yeah, that actually really made my year. October dip, and then finally, right around Christmas, right before Christmas, the Fed said they might raise rates. No, hold on. I'm bad with, I can't remember exactly. This is ancient market history, basically, before COVID. Can't remember anything that happened before COVID, basically. They came out the day after Christmas. It was a non-trading day. Yeah, December the 26th, and said, you know what, whoops, we're not going to raise rates. And that was the Christmas miracle that saved the market in 2018. But yeah, 2018's price basically began with a big rocketing January, huge. And then Volmageddon of February, very dicey year, and then finally a fall off in October. But again, January of 2019, woo! Januaries are crazy, and we had one. I wouldn't go as far as to say that you always want to assume that you're going to get a rip in January, but this year's rip was both normal for me, but also not something I just immediately bought into as a given. And that comes from my lived history in January's past. Has something to do with people allocating capital for the year, doing their, what was it called? Tax loss harvesting at the end of the year and then buying back in. Whatever the phenomenon is, Januaries are crazy. And of course, this year we had one too. But, as one of my friends pointed out, if you look at the yearly bars, well, let's do the 3-month. It's very close for this first 3 months of the year to close that bar red, meaning that we're lower than when we started the year, January, which we were today, briefly. But very, very precarious as we go into this last end of the month. All right. All right, let me check my other chats. Yeah, you can ask about Meta and RNDR. We'll look at that in a second. Got 2 people wanting that. So let's do RNDR first. RNDR. Mass code. Okay, you need to give me the symbol. Is it this? Oh, good. Another pump. All right. So these I'll analyze in the same way. And I really wish you guys would ask me about this when it's right about here. That would be nice. But I always seem to find out about these things either here or here. Seems to be the case when people finally get interested in these things. It's okay. It's just a thing. Let's go back in time on this. Here's how you play or don't play a pump. Something's doing nothing for a while. And you finally get a big movement. Now you're interested. You see it on social media. People start buzzing about it. And they're buzzing about it because they want people to notice and buy it because they're already in. It's very important to acknowledge that. So what you do if you're finding it late is a whole little pump. All right. What you're looking for is one of two things to happen. Pull back to the 50% and hold it to go up, or break that high and just continue onward. You get one of those two things, you're in good shape. Nothing else. So you actually got that on November of 2022, but it closed back inside it. At this point, I would not get that. That right there is a failure to break out. It did not close above that high. Don't want it. It's not worth it. I know you had hopes and dreams. Stay away. Because more often than not, that's a failure. But we get another big bull run. And I'm sure that there's some... you notice on my watch list right here, I've got XRD. I'm watching that for a friend. And we'll look at that in just a second because I've been talking to him about that. But now you got another one of these big pumps. All right, let's measure it out again. This is our new pump, the one we're looking at today. February. See, did it finally top out? Wait for it to top out. You're probably finding out about it there. Yeah. Breaking higher. You're playing the breakout. You know, notice how even if we drew it like that, we came and saw it today, we get a close above the high, hold the high. That's good. That's what you want. If you want to jump in, you want to try to ride the leg of the momentum, that's fine because you can still get a little more. But it's really not worth it because this kind of thing happens. You got to be willing to really play deftly. But now that you have a really solid high come in, boom. All right, you actually got it. So on either Wednesday of this week, or let's see, no, it's February. Oh, it's February, sorry. Either Wednesday, February the 8th, or Thursday, you're sitting there at $1.29. Let's call it 130. Needs to hold that level. You want to buy at that level, that's smart. And you can play that off of that level for a pretty good bounce, 50%. That's why I trust this in all my analysis. Don't use any of the Fibonacci's. It's just if more than half the people that bought it are holding it, it's going to go up. Think about it that way. But what you need is a big, solid closing bar above that high. You need it to close just like you had it here, just like you had it, or you didn't have it in this last pump. You need that big closing bar, and you didn't get it. And now it becomes a problem. Now you're back to your break even, and you got to figure out what to do. Well, what you do is you say, you know what, and here's my motto. Here's my motto in all things trending, whether it's, a YOLO play or if it's just, something that you're trying to hold. You want this thing to keep going up. You want more people to buy something at a higher price than you bought it. So what I always say about these things is it should have gone. It should have gone when it got back up to that high. People should have kept buying it. They should have gotten more people to take some risk and push it up to 3. But they didn't. And now you're back at your break-even point. Now what you don't want is price to close back below this 50%. That's a problem. So what do we got? We got our first close. Are we going to get a second close? We got a second close. It's done. It's done. I don't care what it does in the future. Your trade's over. Yeah. XRD is another one that I've been watching for a friend. He had another pump happen the same way, where comes up, doesn't make a higher high, pulls back to its 50%, closes below, comes back up. I'm telling him it's done. It's done. It's done. It's done. This is from a few weeks ago. This is back in January. And what you'll sometimes have is maybe this little try, but the rule has already passed. You're basically looking for 1 and 2 to either hold or break that level. You want it to hold that level, but if you have 1 bar closed below it and 2 bars closed below it, it's done for your purposes. Because what happens is if you bag hold, you ignore that, you may even get another opportunity at that same level. But if you ignore it, now you're in that valley of risk that all these pump and dumps end up getting into, where you just get that slow grind down of price back down to the low. And you really want an answer for when it's going to go back up again. And so you ask me, and I give you a lesson on how to trade the next one, because that one's done. So unfortunately, I know that this, I've got somebody on Dexter. I appreciate the question, and I got someone on YouTube asking about that as well at the beginning of the podcast. So I'm curious, where did you hear about this, Dexter? And are you in it? I'm really curious, because I want to know like where on social media people find these things. Because I mean, every week it seems I get one of these questions, and invariably, it's a question about something where it's either pumped and it's really high, or it's pumped and it's falling off. All right, let's go back through the questions, because I'm coming up on an hour. I'm still feeling pretty good to keep going though. So if you got questions, let me know. RNDR is one of those companies are giving away for free. What do you mean? Learn about X and get $1 worth of it free. What does it do? Robinhood did RNDR recently? Okay. Coinbase gave it away? Okay, Twitter. Yeah, I wish that Twitter, Dexter, I don't use Twitter that much. I use it for sometimes the comments on things. I use it to laugh, but it's kind of like the Wall Street Bets phenomenon. For a while, people tweeting about something, posting on Reddit about something can pump up the valuation. But at the end of the day, you really just need to look at the chart. And I would be curious. The problem with these kind of social media fueled pumps is it's a feedback loop of attention. When something is up in the span of a few weeks, 200, 300, 400%, people, again, going back to talking about, AI. Okay, good to know. That's good to know. People, are going to talk about it because people assume that the past is going to continue in the future. Same thing we were talking about with Volmageddon. Sometimes it does, but this is just such a pitfall that has been persistent for years and years and years and years and years. Tilray. Anybody remember Tilray? Anybody a boomer like me? Tilray was a pot stock. Pot stocks were all the rage back in 2018. Tilray. This was before GME. All these bubbles have an anatomy. All these pump and dumps do the same things. Now, I can't tell you how to find them at the beginning. The problem is when a stock is looking, or a stock or a crypto is looking something like, let's go back. When a stock or crypto is looking something like this, nobody cares. You won't see people tweeting about it. Only when it's up triple digit percents do people start tweeting about it, and people get interested and people buy it, because if somebody else made triple digit percent, surely I can too. And that fuels it. But they all operate the same way because they're all based on people's feelings and emotions. And that's why we can chart them, and I can tell you, here's how you can possibly play them, and here's how you avoid getting burned. You know, AI itself, literally AI, is another one of these that it had a big run in January. Again, I originally was thinking that maybe AI would be the theme of 2023. May still be, because ChatGPT was the big buzzword. I just don't think we have a bullish enough market this year to really push it. If we had a bullish market, this would have been the thing. But AI, literally the symbol AI, it did exactly what I've talked about. That's why I already have the chart here, where it pulls back to its 50% level, and then it failed to make a higher, pull back a second time, and failed to make higher. I would love it. I would have loved it if this would have worked out, because that is a really clear, solid proof of price holding a 50% of a trend. But on the top side, we do not have a break of the high. So now you got to wait and see what happens here. If it's going to hold that level again, highly unlikely. Highly unlikely, unfortunately. But yeah, AI was the theme, and of course that was what made Tesla rip as well. Basically everything was bullish in January, but AI especially because of ChatGPT. But that's all kind of fallen off a little bit. All right, let's look at Apple real quick. I know somebody wanted to look at that. I have not been looking at Apple for a while. I got lots of lines. Let me redraw my analysis of it. Apple used to dominate and run the market. It used to be very reflective of the S&P. This is it on a weekly chart. Let's bring a daily chart up. Okay. Chop, 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 chop. The best level that I can give you on that is from the August high down to the January low. Even that's unclean. That's dirty. That's a dirty, dirty level. Because it's a trend, but it's not really a trend. I don't like consolidations because there's nothing really that I can discern. I got nothing on Apple. I'm not gonna BS you with saying I know what's gonna happen. I just don't see an opportunity here that I like. I don't see a false breakout. I don't see a 50% level, and I don't see a Tinkinson recapture. What I think was interesting was in January. Speaking of Tinkinson recaptures, see this right here is an opportunity that I didn't really have time to talk about today. But again, that 9-period Tinkinson, which is basically the 9-period 50%, it lets you see these short-term 50% movements. Like here is Apple on the daily. You had a low January the 3rd of this year, and then you get a little reaction off that low. Okay, see? And if we go on a 30-minute, we can start to see a little bit better. Yeah, so you get a little trend off that low. This is a 30-minute, sets up intraday, boom, pulls back down to that level. That's worth an opportunity to try to play a low. Okay, that's an opportunity that I'd be willing to take. And then, of course, what you want is you want to say, okay, well, this is messy, but we're going to say that this 50% is the trade. And that's why I put a buy order at that 50%. Again, this is I'll look at a trade actually today in the NASDAQ futures, actually two of them. But the premise is this. We're looking for price to pull back to that 50% level of the broader trend, and we're going to start it with the tiny 50%. Basically, if this low is going to hold, that's what it should do. And we can put our stop right below the low, and we can see if this thing will play out in our favor. That's the way you play that. That's the way I play a low, is looking for a short-term 50% to play out to a higher-term 50%. But as far as Apple right now, I just don't see it. I'm not going to take a trade unless I see an opportunity. Do I do live trading? I do. I do it on Discord. I type it in Discord. I don't do a chat room because I work in silence. But link below for the Discord community. I post my trades in real time in the futures chat there if you'd like to follow along. I do not do copy trading services because I believe everyone should learn, but I do share the techniques that I believe in because I like them. They work. They work. You see it every day. NASDAQ, like I was saying, today on the 1 minute of futures, did I delete it? Okay. Yeah. So right around, right before 10 a.m., it was very, very clean Tinkinson TS recapture where you have, okay, clean things up. A lot of traders put tons of lines and indicators on charts, and you'll see a lot of times when I come back to an old chart, I just delete everything and start over. That's because I've been doing this long enough where I'm going to do the same analysis again, but also because you get all these lines, and what are we looking at? Like, where's it going to hold? I don't like old lines. I like clean, fresh charts. So, because we can now look at this in the context of today. This is the jobs report this morning at 8:30. There's a little volatility in here, which, by the way, I'm going to distract myself here. Drew the levels out this morning before the news happened. Before the news happened, from last night, or excuse me, yesterday at 10 down to here, where did price make its way up to? Bink, 50%. Then on the run up from the close yesterday, NASDAQ, yes, it's going to be the same. You had a level at about 12,080 on NASDAQ. And then remember, we got this jobs report happening at 8:30 this morning. So this is the 5-minute chart. And ping, ping. That's why 50% are powerful. That's why they're powerful. Now, it's not powerful forever, but for day trading, it is. All right. So then what you had as it gave all that up is we get a very strong downtrend. And throughout this whole downtrend, I'm updating my 50%. What I would like to have happen is it come to the low back here, but it didn't quite get there. Instead, right around 10 a.m., where I really want to get interested in trading, it does something it hasn't done since the open. Here's the open right here. It finally gives you a close back above that red line, that Tinkinson. It's recaptured. And since we have a big, meaty, juicy bearish trend, we can play a retracement. And so what I do is say, okay, what's the 50% of this little reaction right here, which is going to be our red line? What's the 50% of the reaction? That's going to be about 12,020. But along here, target the 50% of the move down. Stop just below that low. Does that give us a 3-to-1? Yes. And we play it. Now, there's a little bit of data difference on Thinkorswim, where I trade it, versus on the futures here on TradingView. It actually hit that level on the actual futures, but it isn't reflected here. That bothers me a little bit. But as it turned out, it actually got up there anyway. But that's what basically I look for to play highs and lows. That little reaction that comes off of it, and then try to play it as well. What do we have again? On the up move, here to here, right around 11:30. 11:30 is a key timing element. Why? Because Europe goes offline for the day and the week. 11:30 a.m. Eastern. You know, traders pump it up. You have that double, bit of volume from Europe and the United States, but that drops off. And very often, if you have a trend, you need to look to see if it can reverse around that time, 11:30. And what do you have again? You have another Tinkinson recapture. We're going to stop it above the high, and we're going to play that down. Do we get a 3-to-1? Yes, we do. And that ends up being a play down. Did not catch this one because I had to step out for the afternoon. But, yeah, of course, I'm going to miss that one. Ain't that the story of all trading? But took a win out of that. But, again, that goes back to Apple on the daily. That same phenomenon. You get price to come down, you get a little reaction, a little 50%, a little short-term 50% to play it back up to the other 50%. Doesn't require anything else. Only requires a couple of brain cells. And I need that because sometimes I overthink too much. That's why I keep things simple. All right. Thank you all for joining. Thank you all for your questions. I hope this helps you make some better trading decisions. Have a good weekend and trade wisely. We'll see you in the next one. By the way, 4 p.m. every Friday we do this. Links below to join the community. Have a good weekend.